right, hello. Today is Friday, the 25th of August, 2023. I'm Jason Shapiro with crowdedmarketreport.com. And today, for the first time, we have managed to convince somebody to speak with me. And we have what I think is an incredible person here, Bob Elliott, who is just a super smart guy. Has a lot of experience in the markets, had a very big job over at Bridgewater, which is Ray Dalio's hedge fund, which, if I'm not mistaken, is the largest hedge fund in the world, or at least up there, and has had a lot of success. And Bob worked there for a long time doing research and researching systematic ways to capture what they were trying to capture over at Bridgewater. And now he has a company called Unlimited, which does what I think to be something very interesting, which is creating ETFs to track hedge fund returns. So you can get exposure to hedge fund returns without paying the somewhat exorbitant fees that that hedge funds charge. And I think that's amazing. And if he's successful doing that, to me, why would anybody pay 2 and 20 when they can get the same exposure for for an ETF fee? So we're going to speak with Bob about a lot of those different things and how he approaches the market. And so welcome, Bob. Thanks for joining us.
Thanks so much for having me on. I really appreciate it.
Hopefully I got that introduction correct.
You got it all right. I got the gist of who I am and my experience for sure.
Great. So why don't we start by you telling us a little bit about what you're doing at Unlimited. I know there's a ticker HFND, which is live now as an ETF. And from what I understand, you're trying to capture the aggregate of hedge fund returns. Is that right? Is that what you're trying to mimic there?
Yeah, in a lot of ways, you can think about what we're trying to build is like an index fund, a low-cost diversified index fund. But instead of, for stocks or for bonds, we're doing it for hedge fund strategies. And, I think that ties well to my career. I've been a systematic investor for a little over 20 years. Working particularly, long time, as you mentioned, at Bridgewater. Also worked actually in the private side of 2 and 20 in ran a venture capital fund that systematically invested using big data. And so, my experiences at Bridgewater in the hedge fund world, the venture capital world, I sort of recognize that, 2 and 20 managers are pretty good at generating good returns because they're smart and invest a lot in beating the market. But they're also good at charging really high fees. And so, the basic thesis of what started Unlimited was this idea of, well, if we can use our experience and understand how these managers are operating and can see and understand their positioning at any point in time, if we can take that understanding and just put it into a much more lower cost structure, because we can use technology to observe what they're doing, and make it available to everyone, then, it's basically like the same way, stock and bond investing totally changed when we got diversified low-cost index funds. The same thing should and could be true for the hedge fund and other parts, for hedge funds and other parts of the 2 and 20 universe.
Yeah. I mean, so HFND, I think, is your first one, and I believe that you have other ones in the works there to do other sort of indices. But so what does HFND try to track? Is it long short? Is it macro? Or is it just the whole world of hedge funds?
Yeah, the HFND ETF, the goal is to track the overall hedge fund industry returns. Now, our view is, because we're doing that at a much lower cost structure, 95 basis point management fee instead of a 2 and 20 typical structure, that it should over time outperform the aggregate of the hedge fund industry. And so that hedge funds is kind of like a very wide net in terms of what it means. But really what it means is it's just a bunch of different alpha generating strategies, a bunch of different managers, 3,000 managers, 5 trillion in assets, that are trying to beat the markets every single day and investing a lot in it. And so it includes strategies like equity long short, fixed income strategies, global macro, managed futures, strategies in the emerging markets. All those different strategies come together. And so in a lot of ways, what I like to think about for HFND is it's kind of like a diversified alpha portfolio. where you're sort of getting access to each one of those different strategies all in the same package.
Yeah. So is there a specific like index that it tries to track or anything like that when you guys like check for yourselves, like, hey, how are we doing and what we're doing? Is it like some kind of Credit Suisse diversified hedge fund index?
Yeah. So there's a bunch of different hedge fund indices out there that, and Credit Suisse is one of them. Credit Suisse is well known from the institutional perspective as kind of being the main index that people often track, but there's also HFRI. Bloomberg now is in the business of hedge fund indices, as well as, Eureka Hedge, Preqin, the list goes on. And the reality is each one of those indices, I won't bore people with the details, are all slightly different. They have different constituencies. And so what we actually do is we just kind of look at all of them and kind of blend them all together, since they each are kind of like a different, somewhat random sampling of the universe. And so we just kind of average them all together when we think about what benchmark we're trying to capture.
Right. So when you put together this thing, and I assume you use some kind of machine learning or something that I would know nothing about, but were you able to then sort of back test it and see how that back test did against, the benchmark?
Yeah, exactly. The machine learning that we use is in some ways like not that different than I think what a lot of investors do when they like look at a manager's returns and they kind of know what they invest in, and if they can kind of infer what managers are doing because they know the outcomes and they know how the market's played out and they know what they invest in. And that's really what we're doing. We're just doing it in a more computationally rigorous way than kind of like eyeballing it. That's all we're doing. And the machine learning is just a tool or techniques that are particularly effective at solving this sort of problem through time. And so that's really what the technology and the underlying strategy is really all about. It's not some black box random thing. It's totally inspectable, common sense. You'd sort of understand it. It's just you have to sort of use machine learning as a way to create sort of probabilistic understanding, which is different than like a typical regression type approach.
Gotcha. And how long has HFND been around now? A little less than a year? Or?
Yeah, it's been around. Started in October, so I don't know, 9 months, give or take.
And how has it to this point tracked sort of the aggregate index of hedge funds?
Yeah, I mean, through time we expect it to track the overall, sort of that blended mix of different hedge fund indices, and so far from what we can tell, the technology seems to be working relatively well, consistent with what we'd expect. As a simple example, the strategy through July was up about 6% since inception, and our sort of measured hedge fund index was up about the same, sort of mid-single digits during that time frame. And I'd emphasize that is during a time when like the S&P 500 is up, was up more than 20%. So this is, of course, you'd want your strategy to go up as much as it can, but the real question here is the technology doing what it's supposed to be doing through, once we've now gone into real time, like leaving back history aside, back testing aside. And the reality is it's delivering the returns consistent with what we'd expect, and we're pretty happy with that it's really been able to sort of work pretty effectively in quite a volatile market environment.
Yeah, no, clearly I think that's the big mistake that a lot of people make in this world is what the S&P 500 has done or hasn't done is not relevant to, if people are investing in a suite of hedge funds, be it yours as one big suite of hedge funds. The point is portfolio diversification, right?
Right, exactly. And at any point,
to have different returns,
right?
To have different return streams in your portfolio, so that over time you get the efficient frontier type of thing, or hopefully push out the efficient frontier, right?
That's exactly right.
So that whole thing of the S&P is up, you're only up 6.
Well, I think actually a really good
anybody who has that conversation either needs to go read a book on why they're investing in this type of stuff, or just go away. I think
Yeah. Well, I think a lot of people, even like a relatively, a lot of people are like focused on the last 6 months or something like that, or year to date, and forget that we just lived through 2022, which was like not a great environment if you're a bondholder or a stockholder. And so as an example, if you just like look at how hedge funds have done since January 2022, which is really when we started entering this sort of tightening phase. Like
Yeah.
hedge funds are up over that time frame, whereas obviously bonds are down meaningfully, as are equities, even with the significant bounce that we saw this year. So I think that kind of gives you a sense, like, the aperture for the performance of these products is not like on a 1 week or 1 month or 6 month basis. The idea is you typically, as an investor, want to allocate to alternative investments as a strategic asset allocation, which should perform well and provide diversification during challenging market environments. And that's essentially what we've had. Like, imagine you just sort of imagine you went through this environment, going through the ride that you have on stocks, down 20%, then up, right? Up almost 20%. Like, that was that was pretty unpleasant. Imagine you were going through that market cycle in bonds, which basically bonds are just sold off the whole time. And instead, what we see is with hedge fund performance is that their performance was basically flat through most of 2022, and then moderately positive over the course of the last 6 or 8 months. And so that's a lot less pain, let's say, and heartburn through that process than if you were just invested in equity or bond.
No, there's no question. It's all about the diversification of the whole thing. I go through this with my clients, where when I was raising money, I used to tell people, look, don't hire me because my last whatever X number of months has been good. Don't hire me for my return. Do not hire me for my returns, I used to say to people, and they'd be like, well, what do you mean? No, that's what we're trying to do. Hire me because of my correlation. That was my whole thing, right?
Right, correlation.
I can't guarantee you returns, but I can come close to, based on the way that I invest, I can guarantee you my correlations, or come close to guaranteeing you that my correlations are going to stay steady. So if that makes sense for your portfolio, then by all means, please invest in me, not because of the returns. And I think that it would be the same thing with anything, but
yeah, with alternative investments, it's never, and I think that's kind of the interesting thing that you see when you look at alts managers. Like, it is like, through time, like hedge fund managers, like some people like sort of think about hedge fund managers like being these like wild, crazy hotshots that are trying to generate like double and triple digit returns. It's like not really true in general. Like, most hedge fund managers are like prudently managing to like a 10 or 12% return target over time, and trying their best not to take too much risk. And so what that kind of looks like over time is that when times are like booming, they're almost always below or behind the indices, but when times are bad, they're typically more conservative and protect capital. And that's actually a pretty good return stream when you can, if you generate pretty good returns when times are good, and you can preserve capital when times are bad, that actually gets you, equity-like returns with a lot less volatility, a lot worse drawdowns, a lot better drawdowns, I should say, a lot better drawdowns with the hedge fund strategies than just common index investing.
No, there's just no question. That's what this is supposed to be about. I don't know that everybody does that, because you do get a lot of people that are return chasers at the end of the day. But
that's certainly true.
Yeah, but that's definitely what this is supposed to be about: diversifying your portfolio. And in the end of the day, is your return to drawdown better? Is your Sharpe, or however you want to measure that, better
Exactly.
than patiently, and therefore you're pushing out your efficient frontier, and that's where you want to be over time, right? Whether people have the patience to do that, or what I mean, is a whole nother story, but they certainly should. If you're,
Absolutely.
to me, if your whole thing is you're a 60-40 portfolio, then certainly, I don't know the numbers, but let's call it a whatever, 50, 30, 20 into something like HFND is going to get you a better risk-adjusted return over time, because it's a different return stream with non-correlation. I think that's what, again, as you know, but that's how people should be thinking.
I think that's right. And when you look at like how big institutional asset managers manage their portfolios, and if anything, actually, Unlimited was a bit inspired by these folks. People, when I was at Bridgewater, which basically just has institutional investors who are investing there, what you see those funds are able to do is they build diversified hedge fund type portfolios. The biggest of which of those funds have enough pricing power that they can beat down the fees, and they allocate about 20% of their portfolios to those assets over time. And so I think, you know, that is a good, and those are the biggest, most sophisticated asset managers in the world. There's a lot, you know, they can invest in anything that they want to invest in. And what we see is that, you know, for a variety of reasons that, you know, from a portfolio construction basis, like a 20% allocation to hedge fund style strategies is about what the optimal allocation is. And if you can get access to that in a way that's diversified and low fee, that becomes a really compelling component of any portfolio. I think the thing that's really, like, if you go talk to folks who are looking for like alternatives, most of what people are focused on in terms of alternatives are things like private credit, private equity, venture capital, but all those things are essentially just more volatile versions of public equity markets in one form or another. Now, they may look like they have less volatility, but like, that's not the way the world works. You get more return for taking on more risk when you're engaged in long only passive portfolios. And so much time and attention is being focused on these strategies that frankly offer no diversification benefit to a 60-40 portfolio, none. They do not improve your Sharpe ratio in reality. And so why are we spending so much time thinking about those strategies when there are these other liquid public market strategies that can improve diversification in an investor's portfolio? And now they're increasingly becoming available at a reasonable price.
Amen to that. And of course, the answer to your question is return chasing.
Right.
And how old are you, Bob?
In my 40s.
All right. I mean, I'm 56, and I've been trying to sell this idea for a very long time. Not what you're doing, but the idea of, you know, the purpose of this stuff. It'll drive you crazy because at the end of the day, 90% of the people are going to hear it and understand it, and then they're going to be like, "Okay, well, give me something that made 40% last year." But yeah, no, there's no doubt. And that's why my original question was, you know, how well does your thing track to the overall hedge fund? Because really that's your only job is to track it. You know,
that's the only
getting
job.
the exposure will give you the diversification. So if you track that, then that's really your only job. And doing it at low fees like that, to me, it's just like I say, if it tracks correctly, it's a home run to me.
Well, hopefully. That's what we're banking on.
Well, it's two things. As long as it tracks, then the argument is not even an argument. This is tracking this. So either, you know, invest in our thing at such low fees, or go out and try to find 30 different managers that you all got to monitor and fund and pay to in 22. You know what I mean? Like, to me, that's a no-brainer. But then, of course, comes the sales pitch of, you know, hey, do this for diversification purposes, not because you're chasing, you know. And we see it so much, right? I mean, Tiger Management is a perfect example, right? Like you say, there is no risk, you know, there is no reward, extra reward without taking extra risk. So it's great. Tiger Management had these massive years and then
lost 50%.
They lost 50%. I mean, that's what it is.
Yeah,
Doesn't
yeah.
mean they're any less smart than they were before. They're just not miracle makers. There's no such thing as a miracle maker. You know what I mean?
That's totally right. And I think actually, like, the only miracle maker in this world is diversification, right? And I think it's actually really, the Tiger Global thing is a good example, which is like, say you're trying to build a robust portfolio, right? What you have to do is you have to understand what the nature is of the returns that you're putting in, right? And if you think about bond returns, you have a pretty good sense of what those look like, and stock returns, you have a pretty good sense of what they look like. But if you invest in single managers, a small selection of single managers, the dispersion is so incredibly wide that frankly, it's like adding a totally random allocation. You could have 50% up all the way down to 50% down and everything in between. And so how do you even think about how much risk are you taking, how much allocation you want to do? And that's, I think, one of the key things that's really beneficial for investing in diversified alpha, or like a hedge fund index style alpha, is that what it allows you to do is you have a much clearer sense as to what the nature of that portfolio or that strategy will look like over time than you do from single managers. And that just makes it a lot easier to start to construct, how do I build my portfolios? How much do I allocate? how much risk should I take, and how comfortable am I with any particular allocation to these strategies.
I couldn't agree more. Having been a person who went through, God, I don't know, 20 years of raising money, from institutions like this, and being on, in marketing meetings with God knows how many hundreds and hundreds and hundreds of these people, and then working for hedge funds that were also raising money. And I'm even involved with a place now that has allocated me money that is a multi-strategy hedge fund, and they're raising money, and I try and help them as well. So having been through that process, God knows how many thousands of times, and seeing how these people end up picking a manager, I mean, it's all so random, you know what I mean? Like,
the insider tells the reality, which is
no, it's so random.
random.
It's so random. So that to me, it's silly. Like, if you think you're going to pick those 4 managers that are going to do so much better than everybody, you're kidding yourself, man. And you're going to look at the last 2 years and be like, oh, well, look how well they did the last 2 years. They're awesome. So let's give them money. It's so silly. There's so much, what do you call it? Survivorship bias involved there to begin with, that like, it's just so silly to me. I was always like, you should pick the guys that had the worst 2 years, because they're probably not going to have the best 2 years going forward,
I think actually that's one of the things that's super interesting. We've actually been doing some research about recently, which is the performance, or the outperformance persistence question. And the gist is, if you look back over the last 20 years, there is no manager outperformance persistence. None. Like,
No.
the likelihood, if you're
there couldn't be.
Right. If you're an above mean manager, or above median manager, in the first year, the odds that you're above the median in the second year is 25%, and the odds that you're above the median in the third year is 12.5%, and the odds that you're above the median, in the next year is 6.25%. Like, literally equivalent to randomness, right? And so I think what that highlights is that you can, like, go try to find X, Y, and Z manager to hope that they're going to continue to outperform, but you're not doing much better than random. And so you're a lot better off in that scenario. It's not like all the funds are bad. In fact, if anything, it's the opposite. Like, if you put all the funds together, they're actually pretty good, particularly when you don't have to pay 2 and 20 fees. It's just that effort, all that effort to try and pick all the individual managers, like, it's random. And in the same way, a lot of these allocators, if you said to these allocators, you got to pick stocks in the S&P 500, they'd sort of look at you and go, I don't know. Who knows what's going to happen in the S&P 500? I'll buy the index. Like, that's exactly, but here, in picking managers, they think that they can infer from the tea leaves that they're better than random at picking managers, when the signals that they use to pick the managers have no persistence. They are random.
And I mean, I don't want to make you depressed or anything like that, because you're putting a lot of money and time into building a business that makes a lot of sense. But the answer clearly to all of that is they have to justify why they're getting paid a salary. I mean, if somebody were to just show them what you're doing here, we're going to get you a diversified hedge fund returns right here. Okay, well, then what the hell do I have these 10 people that I'm paying $350,000 a year salary for trying to pick this, right?
Right.
So they're never going to, they're never going to tell them that, because then what the hell do they do? Why do they have a job, right? To me, that's just reality, right?
Totally.
I truly have always said that 95% of the reason any of these people pick a manager is for job security, and that's it. No one's going to fire you for giving money to Millennium. Millennium can blow out, right? But you're not going to get fired, right? You give money to some new manager and he blows out, then you're going to get fired, right? So
that's definitely right.
It's all about that. Which, I mean, the good thing with you is you're not going to blow out, because you're a diversified hedge fund. So
it's quite some days people tell me that the whole thing is pretty boring, which is that's a good thing. The asset management business, you want to be boring.
That's what it's supposed to be. Yeah. So let me ask you a couple things that, if you don't want to answer, we can cut out. This is just really for my own benefit. But first of all, the idea that and getting back to what you just said, I always go back and I say, like, everybody knows the whole thing about index funds came to be because everybody finally, after 40 or 50 years of mutual funds, figured out that nobody outperforms the market, right?
Right.
So why spend your money investing with an active manager, right? When you can beat 98% of them by investing in an index fund.
Yep.
Why even do it, right? But then somehow those same people that came out of business school and went and became long only active managers became hedge fund managers.
That's right.
So why all of a sudden can they beat on a long short strategy when they could never beat on a long strategy? It's harder, I would argue, to beat on a long short strategy because, as we all know, shorting stocks is a hell of a lot harder than longing stocks, right? So why people then decided that, oh, we should pay these guys 2 and 20 because they're going to outperform on a long short is just beyond me. It was like they fell into the same trap that people fell into for years, believing that an active manager was going to beat long only, right?
Yeah, I mean, I think when you look at the hedge fund industry, there is a benefit of having more flexibility in a range of different strategies. And I think if you look over time, over the last 25 years, there are these sort of hedge fund style strategies. They do perform better than, say, equity markets or 60-40 or bond markets, in a way that is those strategies outperform, particularly from a Sharpe ratio perspective. But the challenge is once you add in 400 basis points of fees, it isn't very good. The thing that's interesting is that if you can cut the fee cost by a substantial amount, by 80%, then that really does actually change the economics of the whole decision making, because you can start to look at something that previously net of fees was essentially not that much better than index investing, to something that is giving a portfolio diversification benefit that's more meaningful. And so I think that that's really what the issue is. I think too often people are looking at these managers, like the managers are extracting maximum fee value. That's what's happening. Like the problem with hedge fund managers is not their strategies. Their strategies are pretty good. The problem with the hedge fund managers is the fees are too damn high, right? Like that's all there is to it.
Are they pretty good though? Really? I've worked with a lot of these people. Like, to me, I worked at a multi-strategy fund, okay? And they had, like, I don't know, 20 people in there, right? I did my thing, which was sort of a commodities type of thing, but most of them were in the way this fund did it was they had individual sectors. So this guy did energies, this guy did utilities, this guy did REITs, whatever it was, right? And by no coincidence, as we looked at the returns, even month to month, but certainly year to year, hey, the utility guys crushed it this year. Oh yeah, well, utilities were up 25% this year. Hey, the energy guy crushed it this year. Oh yeah, well, energies were up 40% this year. Oh, the energy guy had a tough year this year. Well, energies were down 20% this year. In other words, there was a direct correlation to how well the sub-index did to how well these guys did, right? Which to me, probably very little.
And there is some beta in all of these hedge fund strategies. That, just for perspective, about a third of the return of the equity-like return that you've seen over the last 25 years is beta oriented. I think the thing that, and in any one manager's instance, I think what you see is something that looks just like that, which is, it's like hard to differentiate essentially the alpha that they're generating from the beta that you're seeing as you get, you get to smaller and smaller opportunity sets. The thing that's interesting, I think, is that as you aggregate sort of the wisdom of the crowd, you start to get trends and tilts that in aggregate are pretty good. And so in many ways, what that reflects is not that individual like equity guy or that individual utilities person, but really that the alpha is generated by those who are figuring out how to combine those strategies in the most effective way possible. Yes. So any individual manager,
it's the diversification, just like you said.
It's the diversification.
The alpha isn't diversification. That's really what you said.
Right. The alpha is in the thoughtful diversification, and I should also mention in the appropriate risk management and risk taking given various environments. I mean, it's probably the most boring topic in the world to talk about on a podcast, but like institutional quality risk management is a critical determinant of the consistency of the returns that you see amongst many of these hedge fund managers. And so that really is a critical component, which is, they're not you buy the S&P 500, there's no risk management, right? There's no thought to, are you overweight certain positions? Like a simple example is like, should you really have as much weight on NVIDIA today as you do? Like, there's lots of good,
Can't have a
thoughtful
conversation without talking about NVIDIA.
Right. Yeah. Well, there you go. I like NVIDIA because it's a perfect example of indexing outcomes, which is, you generally would not want to put a heavy overweight on a company which has,
800 times sales.
Yeah, something like 40 times sales or something like that. If you just look back through history, that typically is not a particularly good strategy over even the median, over who knows, the short term is somewhat random, but even over the medium term, that's not a good strategy. But that's what comes with indexing. You buy the S&P 500, you get NVIDIA at 40 times sales. That's the way it works. Right. And so a lot of the benefit that these strategies have is in that careful risk management, in that portfolio diversification, strategy diversification, and risk targeting that evolves over time and generates a lot of the incremental outperformance.
Right. No, I think there's no question about that. And it's just like, I preach this every day of the week, when I'm trying to help people learn how to trade. I'm like, risk management. You want to learn how to trade?
Risk management.
End of conversation, right?
That's totally right. Because I think in a lot of ways, what people realize, it's easy. If you've been around in this business long enough, you have the scars of failure all over you. Right? Because trading markets is hard, and you have inevitably made terrible calls many times over the lifetime of a career. I certainly can say I had over the last 20 years. And the key question is, if you think in aggregate you have edge, some sort of edge, right? Then it really comes down to putting yourself in a position to bet that edge as many times as you possibly can, both in a moment by diversifying across a lot of different views, but also through time. Because if you blow out, you're dead, right? So the best strategy, if you actually think you have edge, is to diversify your bets, not be overweight on any particular bet. And with that, you should get a more consistent return stream and ability to keep playing the game, even when you get certain positions, views, and things like that badly wrong.
Stick around long enough to get lucky is what I always say.
Oh, that's right. That is definitely right. And there's nothing wrong with getting lucky. But you just have to have the humility to understand that, like luck can benefit you, but it doesn't mean that you're any smarter, just in the same way that, you can become unlucky, and it also doesn't mean you're any less smart than you were.
That's exactly right. Flip a coin. Just because you got heads doesn't mean you're a genius. Yeah, we're totally in 1000% agreement with everything. Now, let me ask you this, because I know we don't get to do this forever. I could sit here and talk about this for hours, but have you ever dealt with a commitments to traders report? Have you ever worked with that data? What do you think of that data?
Of course,
and
yeah.
What's your view on that data?
Well, I think I think it's a pretty good data set. Of course, there's differences in the quality and the coverage when it comes to different assets. So, it of course covers the futures and options market, the exchange traded futures and options market. Those markets are, I think, typically indicative of what's going on, but it isn't necessarily comprehensive, since, in certain markets, there's a lot of over-the-counter trading and other derivative forms, like in currencies, which is a bit of my specialty. There's a lot of trading, that's not on the exchanges, but it's a good report. It's indicative of what's going on. I think the breakdowns, the real question in all of these circumstances, if you look at any futures contract, right, there's a buyer and a seller. They literally match mechanistically. And so it really comes down to thinking about who's on each side of the trade and what they're likely to do and what their pressures are, in order to understand, who is stretched and who has more room to expand a position in the event that it makes sense for them to do that.
Right. So, I personally, because of the way I trade, I use the commitments to traders. So I'm like a turn picker. I have my theory on markets is that first of all, my theory is most people are going to lose money over time. So what I like to do is find what most people are doing and fade them. That's really
Yep.
all I
Yep.
do, and capture what they're going to lose. So how do I do that in a systematic way? I like to use commitments of traders to find when speculators are super long one-sided.
Mhm.
I'm kind of looking to go the other way, and that's where I catch the market turns. And it's just like you say, does it work all the time? No. But does it work enough times so that the payout has, at least to this point in my life, been much better than the losses, which is on the risk management side of it? The answer is yes. But do you think that, so when you're looking at that, large speculators, so they break it down obviously into commercials, and then the large speculators, which they call the reportables, and then everybody else, which is a small speculator. Do you think the large speculator, I don't know if you've ever looked at this, but do you think the large speculator positioning is indicative of what's out there in hedge fund land? Do you think that's what it's capturing?
Yeah, I think it's important to recognize like these sort of big macro asset classes in terms of things like commodity positioning, currency positioning, and index positioning, stock index positioning, and as well as the positioning in bonds. Like there's kind of a variance, I'd say, in terms of how effective those are in getting a good sense of what's going on. So particularly in some of these smaller markets, like in the commodities market, I think it is, pretty indicative, since a lot of the flow goes through those markets if you're going to be trading, and there's a very robust, commercial set of positions relative to the speculator set of positions. I think the same, well, a lot of the flow in currencies happens off market, right, over the counter and forwards. It's still pretty indicative, would be my sense. And the same is true in bonds. I think in stocks is the one place which is a little more questionable, because there are certainly times when you see these positions, the futures positions, being used as a hedging tool, like an efficient hedging tool. And so you have to be like a little careful during those times to see whether or not what you're picking up is that they happen to be expressing, say, a short side view, a short side hedging position in the futures, and they're buying the long cash equities. That sometimes comes up. I actually think that was part of the thing that was going on earlier this year with the secularly high hedging positions that looked like they were in futures, or short positions, I should say, that looked like they were in futures. I think that was probably indicative of some hedging that was going on against sort of smaller cap long side positions. And so you just have to be a little more careful when you're looking at equity indices, because you might not be getting the full picture of what the risk exposure is.
Yeah, I mean, it's funny. I've had this conversation obviously a lot with people as I went out and raised money, and they say, well, like currencies, for example, you know what I mean? So it's such a small amount of the currency business is done in the futures exchange. How is the COT picking that up? And, I always play ignorant, because I am somewhat ignorant, but I'm like, all I know is, for example, like when I look across the markets and I have, 22 years of history of doing this now. So I can go back and look across. The single best market for me has been equities. Now, we can argue that that's because I get a better read. It's not just the COT that I trade. Yes, the COT has to be super crowded for me to put a trade on, but then I have to wait till I get a read for when to do that. So we can argue I can get a better read on equities because everybody talks about equities all the time and it's on TV. So I can get sort of the better psychological read, maybe we could argue. But I've done very well on currencies too. Now, on currencies, it's because a very small amount of trades have made a whole bunch of money, right? But even recently, I mean, we call it the dollar low. This is all based on COT. I always say it's not me, it's COT, right? So
I like that.
Even the currencies have done well with the COT. So it's funny. I think that all the things that you're saying could be valid, but when I look at the data of my returns, it's just strange that the best returns
that is interesting.
Stocks and currencies. So I guess you never know. Maybe I'm just getting a better read. I don't know.
Well, I think what it indicates, like, and I think discretionary traders too often don't recognize that also there's just like a huge value in the discipline that you bring to the table, right? Like you've got a strategy and you just ruthlessly continue to execute it over and over and over again, and it makes sense if you have edge, which it certainly you know, if you've been doing this for 22 years, you got to have either you're incredibly lucky or you've got some, you got at least some edge in there.
Or I'm just a great salesman.
But you know, like I think that it really speaks to the fact that, okay, like, you know, I can wildly speculate essentially on what I think works and doesn't. Like, you have a strategy, execute the strategy, and if it, you know, if it shows that it's working and that you have edge, you know, keep doing it, but keep the discipline to do it effectively, right? That's the key thing. Is often people will fail on the discipline point and the diversification point.
There's no question about it. Right until she bucks you, and the horrible and the horrible and ironic thing about the entire thing for me personally is that in the last, I don't know, 6 to 7 weeks, I missed my discipline, and it has cost me dearly.
Oh, that's the worst. That is the worst, when you feel like
I never do that. I'm always, people are like, well, why don't you make this trade? Why don't you make this trade? I'm like, look, dude, I've told you exactly how I trade. There's 3 lines in my thing. Okay. If it doesn't do that, I don't do it. And if it does do it, I do it. And you know what? It gave me like a short in the Dow, literally the day high of the Dow. And 2 weeks into it, the thing had gone nowhere. And I hate being short stocks as it is because of, we know why. And I got out of it. And that completely cost me. And then I missed this freaking trade in the dollar too, which was back in the middle of July. I missed it by like a day and a half, and I wasn't going to chase, and I missed it. And those 2 trades alone were just home runs. And it's because I got off my discipline.
Yeah, that's, you know, and
but Leslie, you know, sometimes you need to be spanked back down to
that's right. That's right. Right.
I feel fortunate that I didn't lose money because of all that, you know. Because that has happened to me in the past before, where I got off my deal and I've lost money, right? Which is worse in a way, but and this one I just didn't get the gains that I could have gotten. But hey, sometimes you just need to be spanked back down to get back on.
That's right. You know? And that is, you know, markets are a cruel master. There's no question about that. They are unforgiving.
What do you think about this thing? And I don't know if you have an opinion on this, but like looking at the COT stuff, for example, right? For the last few months, there has been a massive all-time record short interest by these large speculators in fixed income. And I have fortunately my stuff has not gotten long, because it normally would get long because of that, but because I need the small speculators to be in line too, because they're the best fades, and they haven't been in line, so I haven't had to get long fixed income. But from what I've seen, and I can't say, but they say a lot of these hedge funds, now that they're sort of had a very hard time with stocks in the last couple of years, have gone back to sort of their roots, and they're doing a lot of fixed income arb, which is why you're showing a large positioning as these large specs being short fixed income. I don't know if you had a thought on that, or if
yeah. I mean, we, you know, our tech is like looking at the outcomes, you know, looking at the performance and sort of inferring what the positions are from the performance. And I'd say 2 things that you're probably seeing like munched together in that secularly short treasury position. The first is that funds in aggregate, and particularly macro funds, are underweight duration, right? They are about half. They're holding about half as much duration risk as they have typically done on average over the course of the last 25 years. They typically hold a little bit of duration, long duration positions in general. So they're about half of what that is normally. So I think you're seeing some sort of like true shorts on duration. The other thing that's interesting that we're picking up, and I've anecdotally triangulated with some folks in the industry, is a lot of folks are looking at those mortgage spreads, those ABS spreads that have widened to secularly wide levels. And you know, an easier, efficient way that you can take advantage of that is through buying the cash bonds and then shorting out the duration exposure in order to take that spread. And so that's another nuance. It's kind of like the stock one we were talking about that I think is also in there. So it's probably a little bit of both. I think from a quantity perspective, at least how I'm seeing it, is both of those things are intersecting.
I like that one. I think that one makes a lot of sense too. You know, it's funny too, I meant to say it earlier, but when you were talking about, you know, people were earlier this year super short the futures as a hedge to, and people have said that one to me before too, like, oh, you know, you're saying everybody's short, but they're using short futures, so that's just a hedge. They're long stocks, they're just shorting futures as a hedge. I'm like, okay, but if you're hedged, are you long stocks? I don't understand.
Right. And in
You're not
particular,
long
what
stocks. You're
right,
hedged.
you're hedged, right? Which is that, yeah, and that they have
Talk
less.
to me when they're not hedged. That's what I want to get
Right.
short. When they're
Right.
hedged,
Exactly.
which
Like
brings me
earlier
to
in the year, they were holding, because of their hedging approaches, they were holding less equity risk in aggregate than they typically would hold, like 25% or
correct.
between 25 and 50% less equity risk than they typically would. They then, of course, like levered up a little bit in this July thing to do some return chasing, only to get burned by this most recent drawdown. But there you go.
All right, so that'll bring me to my last thing, which is what the hell do you think happened to this market this first half of the year when everybody came in super bearish and super convinced of this recession and the market ripped in their face, which
Yep.
COT fortunately did catch. And I will argue it's all because of that, because I consistently argue it's all about positioning. I'm a big believer that this whole thing is about psychology and positioning and the rest is bullshit. I could be wrong about that. Do you have a different reasoning for what happened? And B, just for the fun of it, even though let's put it in there, Bob is smart enough to know that whatever the hell he says about the future has about somewhere between a 40 and 60% chance of working.
Oh, you got it.
50% chances of not working. So let's not hold him out if he says something and he gets wrong and we call him an idiot. And I would never invest in HFND because this guy's got it wrong. He said SPOOs were going up and they went down, nothing to do with that, but always interested to hear about what you think about all that. My view, just so you can know, and then you can tell me where I'm wrong or where you disagree or if you're good. My view with this whole thing is that right now we're all and this is no big thing, but it's all this yield curve thing. And I'm a big believer that because the Fed has been raising rates, that has stopped the yield, the back end from going up, which is why we've had an inverted yield curve, right? And so taking the other side of that, to me, is the most dangerous thing that happens is if the Fed stops raising rates, because then you're going to get the yield curve explode higher. And then long rates are going to be much higher. And that is what's going to slow everything down and cause recession, right? People are like, how are they ever going to stop this? My answer is stop raising rates, because then the yield curve will go up. And then the long rates, which is where most people operate anyway, will go up. And that's what will slow things down. That's my whole view on this. I have felt that way for a while. The Fed has not stopped yet. And I don't think they're going to tell us when they're going to stop. So I don't know how advantageous that view is, even if right. But that's what I've been thinking. So please let me know what you've been thinking.
Yeah. Well, I think we came into the year and kind of everyone on the street was sort of all in on the sort of recession now framework. And I starting last summer was basically like, look, folks, you have to recognize like macroeconomic cycles like take a long time, like a lot longer than we all remember in 08 or in 2020. And then also, there's a lot of reasons why the transmission of monetary policy today is more muted than the transmission of monetary policy back, say, in the 90s cycles or earlier. And so, my view was basically we're going to have a stronger economy meaningfully relative to expectations. That basically played out. You saw that play out in asset prices through the first half of the year. I think the problem is there's so many people who are all in now on the no landing or soft landing view. I just tweeted something out about the Bank of America fund manager survey, which 75% of the people think there'll be either no landing or soft landing, which is like the probability after, in a late cycle, after all the tightening that we've experienced and QT and the additional supply of bonds that are coming into the market from the government and the bonds that have to be issued from the banks, and the rest of the world slowing down, like the odds that all of those things happen and we get a soft landing or no landing are like, they're not zero, but they're darn close. They're low. They're very low. They're certainly not at a 75 or 80% probability. And so I think that's really what we're setting up right now, which is a lot of people who are basically, the most anticipated recession ever, right, which didn't come to fruition, has caused people to basically pull back on their expectations of recession just at the time when the various dynamics are aligning to actually create the recession that will likely come in the next 6 months or so. So I think that's probably what's going to happen. The challenge, I think, this cycle is, if I told you there's going to be a recession 6 months from now, what would you do in terms of asset positioning? Typically, what you do over the last 30 years is you'd buy bonds, right? That would be the obvious trade to get ahead of the recession. And in this inflationary cycle, with a Fed that's being cautious to ease, and a lot of this duration supply coming into the market, we may well have a circumstance where we get that equity weakness, but we get a bond market that where yields are either flat or going up in that environment, akin to what we saw in the 60s and 70s cycles, at least for the first part of the recessionary period. And that is going to wreck people. Like, people will not be able, people will be totally caught off sides, because it's like, it wasn't the expansion, the soft landing that they expected, nor the type of recession that they're accustomed to. You put those two things together, it's going to be a pretty challenging 6 to 9 months coming.
No, I go back again to what I truly believe, which is you get that, which means you get the Fed not raising, or God forbid the Fed cutting because they have to. I think the long end of the curve is going to be screwed. I really do. And you see it every time they even hint, right, at not raising. Long end goes down, 30 years go down, right? Meaning the rates go up, gold goes up, right? All they have to do is hint at that, and you start to get that stuff. So I think that's going to be the case if things, and it's funny what you were saying, they all were ready for recession, the markets went straight up, and now that they've given up, and that's what I was saying in the beginning of the year, as soon as they give up, I will be looking to short, right?
Right. And now they've all given up, right? Everyone.
And people are like, oh, that's not how it works. I'm like, that is how it works, man.
That is how it works.
You can argue with me all you want. I understand people's thoughts aren't what gets to a recession, but in fact, it is what gets to a recession, right? Because if everyone's coming, then they cut back, and therefore the recession doesn't happen. Then they say, okay, I shouldn't have cut back, I should juice up. Then they juice up too much, and then the recession comes. So it actually does affect, one does affect the other. I truly believe.
And certainly in financial asset markets, expectations matter a lot, right?
Well,
because every time that you're trading against what those expectations are. And those expectations are, the thing that you have to be, you have to have a differentiated view on to generate positive alpha over time. And so, people's feelings matter a lot, actually, to how to think about it.
I believe so. And I think it goes right into I used to have these very long conversations with my mentor, Helmut, about this, where he loved how I traded and he loved how I was doing that. But he's like, it doesn't affect the real economy. I'm like, I really think it does, dude. I wanted to write a whole paper about it. I really think it affects everything. But I think positioning affects everything. But and my last question would be then, because this was freaking me out earlier in the year anyway. I was just because I was bullish and everyone was talking recession. But you asked me, what do you think the market's going to do? And they go, well, there's going to be recession in the third quarter. Okay, but I didn't ask you what the economy was going to do. I asked you what you thought the market was going to do. So my question to you is, does the stock market have to go down if there's a recession? Like, does that have to happen?
Yes.
It does.
Yeah. And the reason why that is because if you look at what's priced into 2024 earnings growth, the expectation is about a 12% expansion in earnings growth in 2024. And typically in recessionary environments, we see earnings decline somewhere between 15 to 20, sometimes 25%. And so it's, that's a heck of a gap, right? If you think that markets are pricing in a 12% expansion and instead earnings fall 25%, that is a huge gap to close that will unlikely be closed through PEs, which are already at secular highs. So
is there not a time that, and I 100% agree with you based on what you just said, that this wouldn't be the time? But isn't there a time where people just say, listen, eventually, every recession, eventually we come out of. And we come out of it, and then the stock market goes up again anyway. So what's the point of freaking selling it now anyway if it's just going to go up? I mean, the discounting method, in other words, you know what I mean? Like, shouldn't we just get to a point where the stock market just kind of goes up, 5 basis points?
If people were so rational,
and gets you your 8% a year, you know what I mean? And like, what's the point? What's the point of selling it off in recession if we're going to come out of the recession anyway at some point, and then the market's going to go back up? Like, are people ever going to get to that point, or no? They're just going to.
I don't think so. I think the vagaries of the human mind are such that there will always be meaningful volatility relative to relative to what transpired.
Let's hope so. All right. Well, I know we're out of time, but I really appreciate your time, Bob. This was
Yeah, thanks so much for having me. This
this
was
was
a fun
awesome. Hope you
conversation.
enjoyed it, and we'd love to speak to you again. And we'll see
Yeah,
you
for sure.
over there in the Twitterverse.
Awesome. Thank you so much for having me. I really enjoyed it.
Awesome. Thanks. And all of you guys out there should check out this HFND, which I think also, by the way, you can look at the positions since it's an ETF. Is that correct? We can go and look at what.
Yeah, the positions are available every day, updated every day on unlimitedetfs.com, and there's also a bunch more information about the strategy, which folks should look at to see whether or not it's a good fit for them.
Right. I mean, if people want hedge fund exposure, to me, this just seems like, I don't know, it's a no-brainer. You know what I mean? Get it for the right reason, and then get it. All right, cool. Thanks a lot.
Thank you so much.